All right, let's jump right into this explainer. When we think about Wall Street and global investment banking, we usually picture complex algorithms, massive capital flows, maybe split-second trading, right? But beneath all that flashy infrastructure lies something completely invisible, yet absolutely critical: trust. It's literally the invisible currency of Wall Street. So today, we're going to look at how the SASB standards take these highly abstract, almost philosophical concepts of corporate behavior and turn them into hard, quantifiable data. Because that brings us to a massive question. How on earth do you actually measure trust in an industry literally built on money? Think about it. It's super easy to measure revenue or a bank's capital reserves. Those are just numbers on a spreadsheet. But measuring trust, that's a whole different ballgame. As we explore the SASB framework, that's the Sustainability Accounting Standards Board, specifically focusing on investment banking and brokerage, we're going to see exactly how financial trust is quantified, reported, and ultimately protected by the world's largest institutions. Here is our roadmap for the explainer. 1. The bedrock of trust. 2. Defining business ethics. 3. The whistleblower defense. 4. Ensuring professional integrity. 5. The cost of misconduct. And 6. Protecting shareholder value. Section 1. The bedrock of trust. So the SASB standards actually break down this overarching concept of trust into two distinct but highly interconnected pillars. First, you've got business ethics. This is your macro-level institutional focus, the really big rules against things like fraud, antitrust behavior, and insider trading. Then, on the flip side, you have professional integrity. This is much more micro-level. It's the human element of client relations, covering things like a broker's duty of care, avoiding negligence, and managing conflicts of interest. And the kicker? Both of these pillars have to be actively measured. Moving on to Section 2, defining business ethics. Now, investment banks are global beasts, right? Which means they're constantly navigating an incredibly inconsistent, ever-evolving web of rules. A compliance standard in New York might look completely different from the rules in London or Tokyo. It's a massive headache. So, business ethics, in this specific context, means strict adherence to rules against tax evasion, money laundering, and corrupt practices, no matter what jurisdiction you're in. And maintaining robust internal controls for these ethics, it's not just a PR exercise. It's not about feeling good. It's the literal shield that minimizes massive legal losses, builds client trust, and ultimately protects shareholder value from some truly devastating regulatory hits. And the reporting gets incredibly granular here. Under SASB metric FN-IB 510A.1, these entities must explicitly track and report the total amount of monetary losses resulting from legal proceedings. And here's the best part: they can't just lump it all into one vague legal fees bucket. No way. They have to specify exactly if the losses came from fraud, insider trading, antitrust, anti-competitive behavior, market manipulation, or malpractice. It's like an X-ray for investors, showing them exactly where an institution's ethical vulnerabilities actually lie. Section 3. The whistleblower defense. So how do banks prevent these massive, highly public monetary losses? Well, they rely heavily on internal defense mechanisms. Under metric FNI B51A.2, we get to see the actual nuts and bolts of a robust whistleblower policy. And it's so much more than just slapping a "call this hotline" poster in the break room. The standards actually require banks to describe whether their hotline is managed by an independent third party. That adds crucial neutrality. Because let's be honest, hotlines are utterly useless if employees are terrified of their boss finding out. That is exactly why requiring concrete incentives for reporting violations and genuinely secure methods for submitting tips are what make this entire system actually function. But here is the real kicker. Banks aren't just tossing these violation reports into a void. The SASB standards mandate that entities must document the concrete corrective actions they take to fix the root cause. If an ethical breach happens, the bank has to spell out exactly what changes they implemented. Did they overhaul management? Did they have to change their technology, fire a sketchy business partner, or maybe completely rewrite their internal operations? They have to prove they actually fixed it. Which brings us to Section 4, ensuring professional integrity. I want you to really think about this for a second. If an investment bank loses its integrity, what exactly is it selling? It's not manufacturing cars or physical goods, right? The whole shebang depends on cultivating client trust. Professional integrity is all about the specific, day-to-day measures taken to avoid conflicts of interest, misrepresentation, and negligence on a case-by-case, client-by-client basis. It means honoring a strict duty of care, literally putting the client's financial well-being way above scoring a quick commission. And this sets the stage for some really fascinating performance metrics. Because the reporting here leaves absolutely no room to hide. Under metric FN-IB510B.1, banks have to calculate both the absolute total number and the percentage of their licensed employees and decision makers who have a record. We're talking records of investigation-related investigations, consumer complaints, or regulatory proceedings. And that dual requirement, it's genius. An absolute number of complaints might look terrifying out of context at a massive bank, but the percentage tells you the real story. It tells you if you're dealing with just a few bad apples or a systemic, firm-wide rot. If a bank makes a habit of retaining brokers with a history of shady behavior, that percentage is laid bare for every investor to see. On top of that, under metric 510B.2, they must track the exact number of mediation and arbitration cases linked to a failure in their duty of care, and they have to break it down. Was the complaint brought by a client, an employee, some outside party? And we are talking about highly specific, messy, real-world disputes. Breach of contract, fights over promissory notes and commissions, or clearing disputes. And what's really interesting is that the SASB standards explicitly exclude unrelated things like, say, wrongful termination suits. This metric is just laser-focused on one thing: professional integrity and client duty of care. All right, Section 5, the cost of misconduct. Let's anchor all of this back to financial reality, because ethics is, for sure, a bottom-line issue. The SASB framework literally forces entities to report the hard cash liabilities resulting from a lack of professional integrity. Metric 510B3 covers all monetary liabilities paid out to opposing parties. So settlements, trial verdicts, regulatory fines, restitution, the whole lot. But here is my favorite detail. The standards require entities to exclude their own legal defense fees from this number. Why? Because they want investors to see the pure, unadulterated financial penalty of the misconduct itself. They don't want the number clouded by how many millions the bank spent on an army of lawyers trying to fight it. The reality of this framework really boils down to one inescapable truth: ethical failures cascade. A failure to meet professional standards doesn't just hurt the poor client who got fleeced by a negligent broker. It creates a massive ripple effect. It damages the institution's reputation, which in turn severely harms the shareholders who entrusted that bank with their capital in the first place. Which leads us to our final section, Section 6, protecting shareholder value. So, the obvious question is, how does management actively ensure these incredibly costly failures don't happen in the first place? Well, this brings us to the final metric we're exploring, FANIB 510B.4, which is all about the management approach. Banks have to transparently describe how they comply with codes of conduct. They have to outline how they oversee advisory services to ensure fair pricing. Crucially, they literally have to prove they are actively maintaining accurate data records and fiercely protecting confidential business information, because let's face it, those are massive vulnerability points. They also need to spell out their processes for internal malpractice investigations and show exactly how they train their employees on an ever-shifting landscape of financial regulations. It's really all about demonstrating proactive governance rather than just scrambling with reactive damage control. As we've seen through these rigorous SASB metrics, financial trust isn't just some invisible, feel-good concept. It is highly, highly measurable. You can literally quantify it through whistleblower data, records of regulatory complaints, and the exact dollar amounts lost to legal settlements. These hard data points form the ultimate bedrock of a financial entity's license to operate. So, I'm going to leave you with this one thought. If an institution can't reliably measure and transparently report on its own integrity, can you really afford to trust it with your capital? Thanks for joining me on this explainer.